All right, traders, today we're going to talk about why the U.S. economic conditions are just right for the stock market to rally to continue. In the second quarter, two of the biggest fears among investors were wage growth and, of course, inflation, and the wonder if it was going to run too hot. Now, heading into the third quarter, we're going to be looking that inflation remains well above historical norms, but there are also growing concerns that the GDP growth could disappoint and corporate earnings and guidance will start showing signs of peaking. On Tuesday, the Labor Department reported that the Consumer Price Index increased 5.4% in the month of June. It's the largest increase in nearly 13 years. On Tuesday, the Labor Department also stating that, hey, the inflation's definitely showing up there. Bank of America's analyst Jared Woodward believes, though, that the U.S. economy is in a sweet spot. Bullish equity market momentum, rising in employment, favorable credit market that will keep the stocks rising in the second half of the year. Bank of America team estimates that U.S. consumers have $2.5 trillion of excess cash following the pandemic. And Woodward said on Tuesday, 70% of the excess cash is being held by the wealthiest 20% of Americans. With this, historically, these kind of go right into the market, at least in excess of stocks and savings. The Fed isn't expected to raise interest rates until 2023, so fears of rising rates will likely not hold back stock prices in the near term. Now, this Benzinga's take here is really that the SPY has really generated 99.8% total return since the market hit its pandemic bottom on March 23rd, 2020. The stock market is clearly pricing in some extremely high recovery expectation, but given more than $6 trillion in stimulus measures, extremely easy year-over-year comps, and no major obstacles on the horizon, the S&P appears to be well positioned to continue its bullish momentum in the third quarter and beyond.